No surprise the Fed left rates unchanged, but the language seemed to focus on inflation a little bit. James, what's your take?
Well, only two changes to this policy statement. One, the characterization of household spending as moderate as opposed to strong as it had it previously. And on inflation, they recognize that it is below target. It is expected to return to target instead of being near target. So I think on both those things, just ever so slightly dovish in their characterization of the economy.
And also no specific mention of the coronavirus. Was that a bit of a surprise to you?
Well, not really. I think that's something that's just developing so quickly that the Fed doesn't want to mention it in their statement one way or the other. It could get better very quickly, obviously could get worse. That certainly is something that we'll hear the Fed chairman be asked about at his press conference, and we'll have to talk about how the committee reflected on the potential risks there. We'll also obviously hear about it in the minutes, but I think in the statement they're really just focused on what they can see in the data and or policy developments that have already taken place.
And just talking about risks, the Fed did tout in the statement a strong labor market, housing is solid. What do you see as some of the risks going forward for the Fed?
Well, we got a little glimpse of it in that one change in their statement about household spending, saying it's moderate as opposed to strong. That has been something that has been a linchpin of U.S. economic growth, supported by strong equity markets, still resilient consumer confidence, and solid housing market. I think over the next year, that will be something in particular to watch. I mean, we've seen a little bit of a lessening in the global uncertainty situation. We probably won't get the support from equity markets or from the housing market that we've had in the previous years, and that just means that we could see a bit of a slower consumer spending. But obviously, given how important that is, 70% of the U.S. economy, that's what I'd say is the main risk. And just behind that, the performance in the labor market, where we've seen job growth start to slow. Not really surprising. We have an aging population. The unemployment rate's at a 50-year low. But that will be something, if they see it really fall off a cliff, that has confidence effects, could hit financial markets, and obviously something that could upset the outlook more broadly.
And given some of those positive economic trends, you talked about the strong labor market, is there still a risk of recession in 2020?
Well, certainly less than there was, say, 6 months ago when bond markets were inverted and where we had really seen a lot of uncertainty on the trade front. I'd say that probably not going to see a recession. And of course, your leading indicators give you maybe 3 to 6 months in advance, and certainly no signs there of a turn. In fact, the weakness we see even in things like manufacturing looks to be bottoming out. Confidence measures have remained resilient. So I would say probably a pretty low chance of an immediate recession. That said, the global economy is still very vulnerable. Growth in Europe still weak. Their manufacturing sector arguably still in contraction. And now you have this coronavirus in Asia threatening the second biggest economy in the world, and of course transmitting out to the rest of the world. So still a lot of vulnerabilities. It's a fragile recovery, but I think the immediate risk of recession, again, certainly less than it was, say, 6 months ago.
James, thank you very much for your time.
You're welcome.